Introduction to real estate cash flow. Real estate cash flow represents the net income generated by a property after all operating expenses and mortgage payments are accounted for. It is the money left over that an investor can keep or reinvest, offering a tangible return on investment. Positive cash flow is crucial for sustainable real estate investing, providing a regular income stream and enhancing financial stability. Understanding this concept is fundamental to building a profitable real estate portfolio that can withstand market fluctuations. This course will delve into various strategies designed to optimize and generate consistent cash flow from diverse real estate assets. Mastering these techniques allows investors to create passive income streams and achieve long-term financial goals. Ultimately, consistent cash flow is the bedrock of a resilient and growing real estate empire. Effective cash flow management involves meticulous budgeting, proactive tenant relations, and strategic property maintenance. It ensures that the property not only covers its costs, but also contributes positively to the investor's financial well-being. Focusing on cash flow minimizes reliance on market appreciation, which can be unpredictable and volatile. Investors who prioritize cash flow build a more stable and predictable income stream, enabling them to weather economic downturns more effectively. This foundational understanding sets the stage for advanced strategies and successful real estate ventures. Cash flow versus appreciation. Investors often focus on two primary ways to profit from real estate: cash flow and appreciation. Cash flow refers to the ongoing income generated by a property, typically from rent, after all expenses are paid, providing immediate and recurring revenue. Appreciation, on the other hand, is the increase in a property's market value over time, a long-term gain realized only when the property is sold. While both are important, cash flow offers financial stability and the ability to cover unexpected costs, making it a more reliable source of income. Appreciation can be significant but is subject to market volatility and is not guaranteed. A balanced strategy often incorporates both, but this course emphasizes maximizing consistent cash flow for financial resilience. Understanding the distinction between these two profit drivers is crucial for setting appropriate investment goals. Cash flow provides liquidity, allowing investors to reinvest, pay down debt, or cover personal expenses without selling assets. Appreciation builds equity, which can be leveraged for future investments or serve as a substantial nest egg. Investors with a shorter time horizon or a need for regular income may prioritize cash flow, while those focused on long-term wealth accumulation might balance both. The optimal strategy depends on individual financial objectives, risk tolerance, and market conditions. Key metrics for cash flow analysis. Several key metrics are essential for accurately analyzing a property's cash flow potential and making informed investment decisions. Gross rental income is the total rent collected before any expenses, representing the property's maximum revenue generation. Net operating income, NOI, is calculated by subtracting operating expenses from gross rental income, excluding debt service, providing a clearer picture of the property's operational profitability. Cash-on-cash return measures the annual pre-tax cash flow against the total cash invested, offering insight into the actual return on equity. Understanding these metrics allows investors to effectively compare different investment opportunities and assess their financial viability. These tools are indispensable for projecting future income and evaluating risk. Beyond these core metrics, investors also consider factors like vacancy rates, which directly impact gross rental income, and capital expenditures, CapEx, which are significant, infrequent expenses for property improvements or replacements. While CapEx is not included in NOI, it is crucial for long-term cash flow planning. Debt service coverage ratio, DSCR, is another vital metric, especially for properties with financing, indicating the ability to cover mortgage payments. A comprehensive analysis using these metrics provides a holistic view of a property's financial health and its potential to generate consistent cash flow. Types of real estate investments. Real estate investing encompasses a wide range of property types, each with unique cash flow characteristics and risk profiles. Residential properties, such as single-family homes, duplexes, and multifamily apartments, are popular for their consistent rental income and relatively stable tenant base. Commercial properties include retail spaces, office buildings, industrial warehouses, and specialized properties like hotels, often offering longer lease terms and higher income potential. Land investments, while offering potential for significant appreciation, typically do not generate immediate cash flow and require a different investment horizon. Understanding these distinctions helps investors align their strategies with their financial goals and risk tolerance, ensuring a diversified and robust portfolio. Each property type presents distinct operational challenges and opportunities. Residential properties often involve more frequent tenant turnover and maintenance requests, but benefit from broad market demand. Commercial properties may require specialized knowledge of business leases and tenant needs, but can offer more predictable, long-term income streams. Industrial properties are driven by economic cycles and logistics trends, while specialized properties demand niche expertise. Diversifying across different types can mitigate risks and stabilize overall cash flow, creating a more resilient investment strategy tailored to various market conditions. Single-family home rentals. Single-family homes are a popular entry point for real estate investors seeking consistent cash flow due to their widespread demand. They often attract long-term tenants, leading to stable income at potentially lower turnover rates compared to multifamily units. Management can be simpler, as there is typically only one tenant to deal with, streamlining communication and maintenance coordination. However, investors must meticulously consider maintenance costs, property taxes, insurance, and potential vacancies when calculating potential cash flow. Location is paramount, as good schools, amenities, and community features can significantly influence rental demand and property value. These factors collectively determine the profitability and stability of single-family home investments. While single-family homes offer a straightforward investment model, they also come with specific challenges. A single vacancy means 100% loss of rental income for that period, emphasizing the importance of thorough tenant screening and retention strategies. Maintenance costs can be unpredictable, as the investor is responsible for the entire property. However, the potential for appreciation in desirable neighborhoods, combined with steady cash flow, makes them attractive. Investors often start with single-family homes to gain experience before diversifying into more complex property types, leveraging their initial success to scale their portfolios. Multifamily property investments. Multifamily properties such as duplexes, triplexes, and apartment buildings offer significant cash flow advantages for real estate investors. With multiple units, the risk of vacancy is inherently diversified. If one unit is empty, others still generate income, providing a buffer against lost revenue. This diversification can lead to more consistent and higher overall cash flow compared to single-family homes, making them attractive for scaling. However, multifamily properties often require more intensive management, potentially higher upfront acquisition costs, and a deeper understanding of complex landlord-tenant laws. The ability to scale a portfolio is also generally easier with multifamily units, as adding units within one property is more efficient than acquiring multiple single homes. Investing in multifamily properties often involves a more sophisticated financial analysis, including evaluating per-unit income and expenses. Economies of scale can be achieved in maintenance and management, as a single contractor or property manager can service multiple units within the same building. This can lead to lower per-unit operating costs, further boosting cash flow. While the initial investment might be larger, the potential for greater returns and portfolio growth makes multifamily properties a compelling option for investors focused on substantial cash flow generation. Strategic location and effective property management are critical for maximizing their profitability. Analyzing rental income and expenses. A thorough and accurate analysis of rental income and expenses is absolutely critical for precise cash flow projections and successful real estate investing. Rental income includes not only the base rent collected from tenants, but also potential additional income streams, such as laundry facility fees, parking fees, pet fees, or late payment charges. Expenses encompass a wide range of costs, including property taxes, insurance premiums, utilities if paid by the landlord, regular maintenance, unexpected repairs, and professional property management fees. Investors must meticulously account for both fixed and variable expenses to avoid underestimating costs and ensure realistic profitability assessments. Creating a detailed line-item budget helps in understanding the true financial performance and cash flow potential of a rental property. Beyond the initial budget, ongoing monitoring of income and expenses is essential for maintaining positive cash flow. Unexpected repairs, changes in property tax rates, or fluctuations in utility costs can significantly impact profitability. Establishing a reserve fund for capital expenditures and unforeseen expenses is a prudent strategy to protect cash flow. Regular review of financial statements allows investors to identify areas for cost reduction or opportunities to increase income. This continuous analytical process ensures the property remains a profitable asset, adapting to market changes and operational demands, thereby safeguarding the investment's long-term viability. Vacancy rates and credit checks. Managing vacancy rates and conducting thorough credit checks are absolutely vital for maintaining consistent and predictable cash flow in real estate investments. High vacancy rates directly reduce income, leading to financial strain, while problematic tenants can result in costly evictions, property damage, and legal fees. Implementing a robust tenant screening process, including comprehensive credit checks, detailed background checks, and verification of rental history, helps significantly mitigate these risks. Understanding local market vacancy rates also allows investors to set realistic expectations for occupancy and adjust rental pricing strategies accordingly to attract qualified tenants. Proactive tenant retention strategies, such as responsive maintenance and clear communication, can further minimize vacancies and ensure stable income. Beyond credit scores, a holistic tenant screening process considers employment stability, income-to-rent ratios, and references from previous landlords. These factors provide a more complete picture of a prospective tenant's reliability and ability to meet rental obligations. A well-defined screening process not only protects cash flow, but also fosters a positive living environment for other tenants in multifamily properties. By investing time and resources into selecting the right tenants, investors can significantly reduce the likelihood of financial setbacks and ensure the long-term profitability of their rental properties, contributing to sustained cash flow. Retail and office spaces. Commercial retail and office spaces represent another significant avenue for real estate cash flow, catering to diverse business needs. Retail properties, such as storefronts, shopping centers, and strip malls, generate income from businesses selling goods or services, benefiting from consumer traffic and economic activity. Office spaces, ranging from small individual suites to entire corporate buildings, cater to professional services, technology companies, and administrative functions. Lease agreements for commercial properties are often longer term and structured differently than residential leases, frequently including triple net (NNN) leases where tenants cover most operating expenses. This can lead to more predictable and stable cash flow for investors, as many variable costs are passed on to the tenant. Investing in retail and office spaces requires a keen understanding of local business trends, economic forecasts, and tenant demand. Retail properties thrive in areas with high foot traffic and strong consumer spending, while office spaces depend on a robust job market and business growth. The design and amenities of these properties play a crucial role in attracting and retaining tenants. For instance, modern office buildings with flexible layouts and advanced technology infrastructure are highly sought after. Successful commercial investors conduct thorough market research and due diligence to ensure their properties meet the evolving needs of businesses, thereby securing long-term leases and maximizing cash flow. Industrial and warehouse properties. Industrial and warehouse properties are increasingly attractive for cash flow, driven significantly by the relentless growth of e-commerce and global logistics. These properties encompass a wide range of facilities, including manufacturing plants, large distribution centers, and various types of storage units. They typically feature expansive, open spaces, high ceilings, robust concrete floors, and multiple loading docks designed to accommodate heavy machinery and large vehicles. Tenants are often businesses requiring substantial space for operations, inventory storage, or distribution, leading to long-term leases and stable income streams. While maintenance and operational costs can be substantial due to the scale of these properties, the sustained demand for efficient logistics infrastructure offers robust cash flow potential for savvy investors. Understanding the specific needs and operational requirements of industrial tenants is key to successful investment in this sector. The strategic location of industrial and warehouse properties is paramount, often situated near major transportation hubs, highways, and ports to facilitate efficient goods movement. Factors such as ceiling height, loading dock capacity, and access to skilled labor are critical considerations for potential tenants. Investors in this sector must also be aware of environmental regulations and zoning laws, which can impact property development and usage. The long-term nature of industrial leases, often spanning 5 to 10 years or more, provides a high degree of income predictability. This stability, coupled with the ongoing expansion of e-commerce, positions industrial real estate as a strong contender for consistent cash flow generation within a diversified portfolio. Lease structures and tenant relations. Commercial real estate cash flow heavily relies on effectively structured lease agreements and strong positive tenant relations. Different lease types, such as gross, net, and triple net (NNN), dictate the allocation of responsibility for property operating expenses between the landlord and the tenant. NNN leases, where tenants typically pay for property taxes, insurance, and maintenance costs in addition to rent, are often preferred by investors for their predictable cash flow and reduced landlord responsibilities. Gross leases, conversely, place most expense burdens on the landlord. Maintaining positive tenant relations is crucial for achieving high retention rates, which significantly reduces costly vacancy periods and ensures consistent income streams. Clear communication, prompt issue resolution, and fair practices contribute significantly to a stable and satisfied tenant base, which is invaluable for long-term profitability. Beyond the financial terms, the quality of tenant relations can profoundly impact a property's reputation and long-term cash flow. Happy tenants are more likely to renew leases, recommend the property, and treat the space with care, minimizing wear and tear. Conversely, poor relations can lead to disputes, early lease terminations, and negative publicity, all of which can erode cash flow. Investors should establish clear channels for communication, respond promptly to maintenance requests, and be transparent about lease terms and property rules. Building your reputation as a fair and responsive landlord is a strategic asset that contributes directly to sustained occupancy and robust cash flow, making it a critical component of successful commercial real estate investment. Due diligence for commercial properties. Thorough due diligence is paramount when investing in commercial properties to ensure sustainable cash flow and mitigate potential risks. This involves a comprehensive review of all financial records, including detailed income statements, expense reports, and existing lease agreements, to verify the property's actual profitability. Physical inspections of the property are essential to identify any structural issues, deferred maintenance, or necessary capital expenditures that could impact future operating costs. Legal due diligence includes meticulously examining zoning regulations, environmental reports, title searches, and any outstanding liens or encumbrances. A meticulous and exhaustive due diligence process helps uncover potential risks and liabilities, allowing investors to make fully informed decisions and protect their projected cash flow from unforeseen problems. Engaging a team of experts, including real estate attorneys, accountants, and property inspectors, is often advisable for commercial due diligence. These professionals can provide specialized insights and identify red flags that an individual investor might miss. Environmental assessments are particularly critical for industrial or older commercial properties to avoid significant cleanup liabilities. Understanding the local market conditions, including comparable sales and rental rates, also forms a crucial part of due diligence, ensuring the property's valuation and income projections are realistic. This comprehensive approach is the cornerstone of a prudent commercial real estate investment strategy, safeguarding both capital and future cash flow. Value-add opportunities. Value-add strategies are powerful approaches for significantly increasing real estate cash flow by enhancing a property's income potential and market value. This involves identifying underperforming properties or those with deferred maintenance that can be improved through strategic renovations or operational optimizations. Examples include renovating outdated apartment units with modern finishes, adding desirable amenities like laundry facilities, fitness centers, or communal spaces, or optimizing property management practices to reduce vacancies and expenses. By investing in these strategic improvements, investors can justify charging higher rents, attract better quality tenants, and ultimately boost their net operating income and overall cash flow. These opportunities often require a keen eye for untapped potential and a solid execution plan to realize their full financial benefits. Successful value-add projects require careful financial modeling to ensure that the cost of improvements is outweighed by the increase in rental income and property value. Market research is essential to identify which renovations and amenities are most desired by target tenants in a specific area. Beyond physical improvements, value-add can also involve repositioning a property in the market, implementing more aggressive marketing strategies, or converting underutilized spaces into income-generating assets. The goal is to create a more attractive and efficient property that commands higher rents and lower operating costs, thereby maximizing the investor's cash flow and equity growth over time. Short-term rentals and arbitrage. Short-term rentals, primarily facilitated by popular platforms like Airbnb and Vrbo, offer a dynamic and potentially lucrative approach to real estate cash flow. These properties are rented for brief periods, often daily or weekly, typically generating significantly higher nightly rates than traditional long-term leases. Real estate arbitrage involves a specific strategy where an investor leases a property long-term from an owner and then sublets it as a short-term rental, profiting from the difference between the long-term rent and the aggregated short-term income. While potentially highly lucrative, short-term rentals demand active management, strict compliance with local regulations and zoning laws, and careful consideration of seasonality and occupancy rates. They can provide substantial cash flow if managed effectively and strategically positioned within the market. The success of short-term rentals hinges on several factors, including property location, unique amenities, and exceptional guest experiences. Properties in tourist destinations, urban centers, or near event venues often command premium rates. Effective marketing, professional photography, and responsive guest communication are essential for maximizing bookings and positive reviews. However, investors must navigate the complexities of local ordinances, which can restrict or prohibit short-term rental operations in certain areas. Understanding the competitive landscape and continuously optimizing pricing strategies are also vital for maintaining high occupancy and profitability. Despite the operational demands, the potential for high cash flow makes short-term rentals an attractive option for many investors. BRRRR method for cash flow. The BRRRR method is a powerful real estate investment strategy designed to generate consistent cash flow and rapidly build a portfolio using minimal upfront capital. It stands for buy, rehab, rent, refinance, repeat, outlining a cyclical process. The journey begins by buying an undervalued property, often distressed or requiring significant repairs, at a discount. The next critical step is rehabbing it to increase its market value and appeal. Making it suitable for rental. Once renovated, the property is rented out to generate immediate and consistent cash flow, covering expenses and providing income. The key step is refinancing the property based on its new, higher appraised value, allowing the investor to pull out their initial capital. This capital is then used to repeat the process with another property, leveraging equity to scale a portfolio efficiently. The effectiveness of the BRRR method lies in its ability to recycle capital, enabling investors to acquire multiple properties without continuously injecting new funds. This strategy is particularly appealing for those looking to accelerate their portfolio growth and maximize cash flow. Successful implementation requires a strong network of contractors, a keen eye for value, and a thorough understanding of financing options. Investors must accurately estimate renovation costs and after-repair value (ARV) to ensure a profitable refinance. By systematically executing each step, the BRRR method empowers investors to build substantial wealth and generate passive income streams over time, making it a cornerstone of many successful real estate ventures. Creative financing for cash flow. Creative financing strategies can unlock significant real estate cash flow opportunities, especially when traditional lending options are challenging or unavailable. Seller financing, for instance, involves the property seller acting as the bank, providing a loan directly to the buyer, often with more flexible terms than conventional mortgages. Lease options allow a tenant to lease a property with the exclusive option to purchase it at a later date, often with a portion of their monthly rent payments contributing towards the eventual down payment. Private moneylenders and hard money loans offer faster, more flexible capital for acquisitions and renovations, albeit typically at higher interest rates and shorter terms. Understanding and utilizing these alternative financing methods can help investors acquire properties with less conventional capital, accelerating portfolio growth and enhancing cash flow generation. Other creative financing approaches include subject-to deals, where an investor takes over the seller's existing mortgage without formally assuming the loan, and partnerships or joint ventures, where multiple investors pool resources. Each method comes with its own set of advantages and risks, requiring careful legal and financial due diligence. The key is to identify situations where these non-traditional options align with the investor's goals and the property's potential. By expanding the range of available financing tools, investors can overcome common barriers to entry, acquire more properties, and ultimately build a more robust and diversified cash flow portfolio, even in competitive markets. Calculating net operating income, NOI. Net operating income, NOI, is a critical financial metric for accurately evaluating a property's profitability and its potential for generating consistent cash flow. It is calculated by systematically subtracting all legitimate operating expenses from the property's gross rental income. Operating expenses typically include property taxes, insurance premiums, utilities if the landlord is responsible, routine maintenance, repairs, and professional property management fees. Crucially, NOI specifically excludes mortgage payments, debt service, depreciation, and income taxes, as these are considered financing and accounting expenses rather than operational costs. A higher NOI indicates stronger operational cash flow and generally signifies a more attractive investment opportunity. Understanding how to accurately calculate NOI is fundamental for any real estate investor seeking to make informed decisions and compare different properties effectively. The accurate calculation of NOI provides a clear, unencumbered view of a property's income-generating capability before considering the impact of financing. This allows investors to assess the inherent value of the asset itself, independent of how it is funded. When comparing multiple properties, NOI serves as a standardized benchmark, enabling an apples-to-apples comparison of operational efficiency and revenue potential. Any discrepancies or omissions in expense reporting can significantly skew NOI, leading to inaccurate projections and poor investment choices. Therefore, meticulous attention to detail in gathering and categorizing all income and expense data is paramount for a reliable NOI calculation, which forms the basis for many other key financial metrics. Cap rate and cash-on-cash return capitalization rate, cap rate, and cash-on-cash return are two exceptionally important metrics for assessing real estate investment performance and understanding potential cash flow. The cap rate is calculated by dividing the net operating income, NOI, by the property's current market value or its purchase price. It provides a quick, unleveraged snapshot of the potential rate of return if the property were purchased with all cash, offering a standardized way to compare similar properties. Cash-on-cash return, on the other hand, measures the annual pre-tax cash flow against the actual total cash invested by the investor, making it particularly useful for leveraged investments where debt is involved. Both metrics help investors compare different opportunities and evaluate their relative profitability and risk. While cap rate gives an indication of a property's inherent value and income-generating capacity independent of financing, cash-on-cash return directly reflects the return on the investor's actual equity. A high cap rate might indicate a strong income-producing asset, but a high cash-on-cash return indicates excellent performance relative to the investor's out-of-pocket capital. Investors often use cap rate to quickly screen properties and then delve into cash-on-cash return for a more personalized assessment of their specific investment. Understanding the nuances of both metrics is crucial for making strategic decisions, optimizing financing, and maximizing the return on investment for cash flow-focused real estate ventures. Debt Service Coverage Ratio (DSCR). The Debt Service Coverage Ratio (DSCR) is a crucial metric, primarily used by lenders and astute investors to assess a property's ability to comfortably cover its mortgage payments from its net operating income. It is calculated by dividing the net operating income, NOI, by the total annual debt service, which includes both principal and interest payments on all outstanding loans. A DSCR of 1.0 means the property generates just enough income to cover its debt obligations, leaving no buffer. Lenders typically prefer a DSCR of 1.25 or higher, as this indicates a healthy buffer, signifying that the property can comfortably meet its financial commitments even if income slightly decreases or expenses increase. Understanding DSCR is vital for securing favorable financing terms and ensuring the property's long-term cash flow stability, preventing potential financial distress. A low DSCR can signal a higher risk of default to lenders, potentially leading to higher interest rates or even a denial of financing. Conversely, a strong DSCR demonstrates financial health and increases an investor's credibility, opening doors to better loan terms and more investment opportunities. Investors should always calculate and monitor the DSCR of their properties, especially when considering new financing or evaluating potential acquisitions. It serves as an early warning system for properties that might struggle to generate sufficient cash flow to cover their debt, allowing for proactive adjustments and safeguarding the investment against financial instability. Maintaining a healthy DSCR is a cornerstone of responsible real estate investment management. Property management for cash flow. Effective property management is absolutely indispensable for maximizing real estate cash flow and ensuring the long-term profitability of an investment. This comprehensive process involves efficient tenant screening to secure reliable occupants, timely rent collection to maintain consistent income, proactive maintenance to prevent costly repairs, and responsive communication to foster positive tenant relations. Poor management practices can lead to high vacancy rates, increased repair costs due to neglect, and tenant dissatisfaction, all of which significantly and negatively impact cash flow. Investors have the option to self-manage their properties or hire a professional property management company, each with its own set of advantages and disadvantages. The choice often depends on the investor's time availability, expertise, and the size of their portfolio. While professional property managers charge fees, their expertise and established systems can often lead to higher occupancy rates, lower operating expenses through vendor relationships, and ultimately greater net income. They handle everything from marketing vacancies and screening tenants to handling emergencies and navigating legal complexities, freeing up the investor's time. For self-managing investors, developing robust systems for record-keeping, maintenance scheduling, and tenant communication is crucial. Regardless of the approach, a focus on efficiency, tenant satisfaction, and cost control is paramount. Strategic property management directly translates into optimized cash flow, protecting the investment and enhancing its overall financial performance over time. Identifying and mitigating risks. Real estate investing, while potentially highly lucrative, inherently carries various risks that can significantly impact cash flow and overall profitability. These risks include unpredictable market downturns, unexpected and costly maintenance issues, prolonged tenant vacancies, and adverse interest rate fluctuations. Identifying these potential risks early in the investment process is the crucial first step towards effective mitigation. Strategies to safeguard cash flow include maintaining a substantial reserve fund specifically for emergencies and capital expenditures, diversifying your portfolio across different property types or geographical locations to spread risk, and conducting exceptionally thorough tenant screening to minimize problematic occupants. Proactive risk management is essential for protecting your investment and ensuring financial stability. Beyond financial reserves and diversification, regular property inspections are vital for identifying and addressing maintenance issues before they escalate into major expensive problems. Staying informed about local market trends, economic forecasts, and legislative changes can help investors anticipate and adapt to potential challenges. Implementing robust insurance policies, including property, liability, and landlord insurance, provides a critical safety net against unforeseen events. Furthermore, having clear legal agreements and understanding landlord-tenant laws helps prevent costly disputes. A comprehensive and proactive approach to risk identification and mitigation is a cornerstone of sustainable real estate cash flow generation, protecting both capital and income streams. Market analysis and economic factors. A thorough understanding of market analysis and broader economic factors is absolutely crucial for sustaining and growing real estate cash flow over the long term. Local market conditions, such as population growth, job creation rates, housing supply and demand dynamics, and average income levels, directly influence rental demand and property values. Macroeconomic factors like prevailing interest rates, inflation rates, and overall economic growth or recessionary trends also play a significant role in the viability and profitability of real estate investments. Investors should regularly monitor these vital indicators to make informed decisions about property acquisition, optimal rental pricing strategies, and timely exit strategies. Adapting proactively to changing market dynamics is a key determinant of long-term cash flow success and portfolio resilience. Performing detailed market analysis involves examining demographic shifts, local employment statistics, and future development plans. For instance, an area experiencing job growth and population influx will likely see increased rental demand and potential for rent increases, boosting cash flow. Conversely, areas with declining industries or oversupply of housing may face higher vacancy rates and downward pressure on rents. Economic factors like rising interest rates can increase borrowing costs, impacting the profitability of new acquisitions and existing leveraged properties. Inflation can erode the purchasing power of fixed rental income if not adjusted. Therefore, a continuous, informed assessment of both micro and macroeconomic environments is indispensable for strategic real estate investing and maximizing cash flow. Insurance and legal considerations. Comprehensive insurance coverage and a solid grasp of legal considerations are absolutely fundamental to protecting real estate cash flow and the overall investment. Property insurance is essential to cover damages from perils like fire, storms, or vandalism, safeguarding the physical asset. Liability insurance protects against claims arising from injuries sustained on the property, preventing potentially ruinous lawsuits. Landlord insurance often combines aspects of both, specifically tailored for rental properties. Understanding local landlord-tenant laws, fair housing regulations, and the correct eviction processes is critical to avoid costly legal disputes, fines, and operational disruptions. Consulting with experienced legal professionals and reputable insurance brokers ensures adequate protection and compliance, minimizing financial risks and safeguarding your investment's profitability. Proactive legal and insurance planning is a cornerstone of responsible and sustainable real estate investing. Beyond standard policies, investors should consider additional coverages such as flood insurance, earthquake insurance, or umbrella policies, depending on the property's location and risk profile. Reviewing lease agreements with legal counsel ensures they are robust, enforceable, and compliant with all local, state, and federal laws. Ignorance of legal requirements can lead to significant financial penalties, tenant disputes, and reputational damage, all of which negatively impact cash flow. Establishing clear communication channels and documentation practices for all tenant interactions can also provide crucial evidence in case of legal challenges. By meticulously addressing insurance and legal aspects, investors build a strong defensive perimeter around their cash flow, ensuring long-term stability and peace of mind. Refinancing and selling for profit. Strategic refinancing and timely selling are crucial exit strategies that can significantly impact real estate cash flow and overall investment returns. Refinancing allows investors to adjust their mortgage terms, potentially lowering interest rates, extending loan terms to reduce monthly payments, or extracting equity through a cash-out refinance. A cash-out refinance provides liquid capital for reinvestment into new properties, debt consolidation, or other financial goals, effectively boosting cash flow or providing capital for new acquisitions without selling the existing asset. Selling a property while ending its direct cash flow can realize accumulated appreciation and provide a large lump sum for portfolio expansion, diversification, or other strategic investments. Understanding market cycles and tax implications is vital for optimizing these strategies to maximize financial benefits. The decision to refinance or sell should be based on a careful analysis of current market conditions, interest rates, the property's performance, and the investor's long-term financial objectives. Refinancing can be particularly advantageous when interest rates are low or when a property has significantly appreciated, allowing investors to tap into their equity. Selling, on the other hand, might be the best option in a seller's market where property values are high, or when an investor wants to reallocate capital to more promising opportunities. Both strategies require a clear understanding of associated costs, such as closing fees for refinancing or capital gains taxes for selling. Strategic timing and expert advice are key to executing these moves profitably and enhancing overall cash flow management. Scaling your real estate portfolio. Scaling a real estate portfolio effectively is a crucial step towards long-term wealth building through consistent cash flow. This involves strategically acquiring more properties while simultaneously maintaining efficient management of existing assets. Key strategies for scaling include reinvesting the positive cash flow generated from existing properties back into new acquisitions, leveraging accumulated equity through strategic refinancing, and forming partnerships or syndications to pool capital for larger deals. Automation of routine property management tasks, establishing clear systems for tenant screening, and cultivating a strong network of reliable contractors are absolutely essential for managing a growing portfolio without becoming overwhelmed. Scaling allows for greater income diversification, increased financial stability, and accelerated wealth accumulation, making it a cornerstone of advanced real estate investing. Successful scaling demands a disciplined approach to financial analysis and operational efficiency. Investors must continuously evaluate market opportunities, identify properties that align with their cash flow goals, and secure favorable financing. As the portfolio grows, delegating tasks to professional property managers or virtual assistants becomes increasingly important to maintain quality and prevent burnout. Building strong relationships with lenders, brokers, and other investors can also provide access to off-market deals and larger investment opportunities. The ultimate goal of scaling is not just to acquire more properties, but to create a robust, self-sustaining, income-generating machine that consistently delivers positive cash flow and contributes significantly to long-term financial independence. Long-term wealth building through cash flow. Real estate cash flow is an incredibly powerful and sustainable engine for long-term wealth building, offering a clear path to financial independence and security. Consistent positive cash flow provides a reliable stream of passive income, which can be strategically used to cover living expenses, accelerate the paydown of existing debt, or acquire additional income-generating assets. Over time, this compounding effect, combined with potential property appreciation and the reduction of mortgage principal through debt paydown, significantly increases an investor's net worth. By focusing on smart acquisition, efficient property management, and strategic reinvestment of profits, investors can create a robust and ever-growing stream of income that supports their financial goals for decades to come, moving towards true financial freedom. The beauty of cash flow-focused real estate investing lies in its ability to generate income regardless of short-term market fluctuations. While appreciation is a welcome bonus, the consistent monthly income provides stability and predictability, allowing for long-term financial planning. As properties are paid off, the cash flow from those assets increases dramatically, freeing up capital for further investment or personal use. This systematic approach to building a portfolio, driven by strong cash flow, creates a legacy of wealth that can be passed down through generations. It transforms real estate from a mere asset into a powerful tool for achieving lasting financial security and prosperity, making it an ideal strategy for those committed to long-term financial success.